Welcome to Institutional FX Uncensored, your free weekly FX podcast. Listen to professional FX traders, currency hedge funds, and FX brokers from around the globe discussing the latest FX news, trends, and regulations. Be ready to navigate through the uncharted waters of the foreign exchange market like no one else has. Tune in.
Hi, everyone, and we have an excellent episode for you today on the very hardest topic in the world of investing. It's how to raise funds. Welcome to the Institutional FX Uncensored podcast. I'm your host, Natallia Hunik, and today we will discuss how to raise funds for your hedge fund. My guest is Ronald Richter. He's a co-founder and managing partner of Bright Valley Partners, a boutique advisory firm that provides best-in-class corporate finance, investment advisory, and capital raising. Welcome, Ronald.
Thank you, Natallia. Thank you for having me.
I'm happy to have you here at the podcast, Ronald. So you have an ample experience in the field of capital raising. Can you share with the audience a little bit about your background and what prompted you to start and found Bright Valley Partners?
Sure. Look, not to make a short story too long, it's pretty simple. I spent 14 years of my 20 and odd something career on the investment side. Ran a few fund of funds. I was on the advisory side too, so mainly researching managers. So I got a good sense of what clients and investors are doing on the investment side and how they look at funds and what they require. After 2008 and 2010, where obviously hedge funds, and especially also where I'm coming from, Switzerland and Geneva in particular, were heavily impacted by what happened with Madoff and the great financial crisis and the liquidity mismanagement, to put it in brackets, of funds. The entire activity slowed down quite heavily. So I started thinking about maybe finding other options outside of finance, and if staying in finance, then looking into how to use the best my expertise and experience into something different. And that's how I was working here in London at a Cedar, and I was seeing a lot of, still obviously and as usual, a lot of demand from managers to be exposed and introduced to investors, to new investors. And there was obviously there is and still is, and obviously was there at that time, a gap to fill and to help early stage managers to raise capital. So I decided in 2014 with an industry friend, a long-term industry friend, to look into this, and we co-founded Bright Valley Partners in 2015, in the summer of 2015, with a couple of clients, new funds, and launched that way, and started focusing primarily on hedge funds. And then this allowed also to broaden up a bit the expertise that we both had into other stuff in the space, i.e. private equity, private debt, real estate, etc. So we have executed a fair amount of mandates in those spaces, with some success and also with failures, obviously, and it's been difficult. Focusing primarily on very early stage managers has been a tough job. So and it still is today. So that's how it is. That's how we made it up to here.
Oh, great. What a story. I just know from talking to a lot of those early stage fund managers, and I'm sure you do too, that fundraising is the biggest challenge for them when they're launching a fund. When we had the expo, Forex Hedge Fund Expo in 2020, which you were a part of, we asked people to, kind of cite the reasons, why they're hesitant about launching their fund, and the lack of personal network was the number one cited reason. How do you think important that is to have that personal network when you launch the fund? Is it possible to close that gap of lack of personal connections by using firms maybe such as yours, or perhaps using some other services for capital introductions? Or is it super critical that you do have that personal network that you do have from that hedge fund background, and you need to have that network to launch? What is your opinion on that?
I don't expect a CIO of a hedge fund to have a network of 50,000 investor connections. Not at all. What I expect from him is to have a strategy that works, and him to have a good pedigree, and him to have a track record if possible, and hopefully a bit of his own cash in a strategy that has some proof of concept. So that's what I expect. So no, it's not impossible at all. And I don't think that if you look at how hedge funds are structured, the hedge fund is a business in the end, like any other business, like private equity businesses, like a bank, etc. Everyone has his own side of the business to look after, and the hedge fund business is three sides today. I view it as three pillars. One is obviously the strategy. Otherwise, without the strategy, there is no fund. Then you have the operations, which, as we all know, have become of utmost importance for a lot of people, and especially institutions. And last but not least, and which is, I think, overlooked by many managers, is the business development side of things, where a lot of managers feel that, yeah, I have a strategy, I have a decent setup with decent service providers, I will just post some nice figures and maybe a year or two of good returns, and people will come. Unfortunately, we are no longer in the year 2000, 2001, 2, 3, 4, where that was possible, and we were seeing money flowing into the industry, and it was just opening hands, and money was landing in our hands. All the good old days, but it's no longer the case now. It's really a lot of work in terms of relationships, and building these relationships, and understanding what investors want, and how they structure their asset allocation. Does that specific strategy fit in there, etc. So it's a full-time job. So you need someone. I would expect, if possible, to financially, I mean, from a manager, to have either one person internally dedicated to this, a CEO or a business development person, a sales guy, or to externalize this to third-party marketers, or rely a bit more on their prime brokers at the beginning, etc. So it's to me, it's a very important base or foundation of when you want to build a hedge fund business, or any other business, by the way, in the fund business. So look, yeah, you don't need 150,000 connections, but I think you need someone who has those connections and works for you. Definitely.
Right. And that was my follow-up questions, because when I speak to a lot of the kind of the startup funds, it's always a challenge to them. It's like juggling between being able to run the strategy and be successful in trading, and on the other hand, it's one person who typically also, that same person who also does the fundraising, and it's difficult. Sometimes people just don't have both sides. Like they're not, they're probably talented trader, but they're not a really good business development. At what point, I mean, is there like an AUM or I don't know, some other indicator? At what point should they hire that business development person? Is it like in the right at the start, or do they have to ramp up the AUM a little bit and then hire the business development guy? What's your point of view? Is it a must to get started?
There are no rules. Again, I totally agree with you. It's not only the question of background and experience. If you have both, and the connection and the investment expertise, then great. Maybe you can start a product, start a fund, a business, without really relying on someone else, and try to get. And it depends also what strategy is. Some strategies are more time consuming, And you cannot do everything. And I think that's the other point that I wanted to make. It's the time. Do you have time to deal with all of this? And especially when you launch a fund, you have to launch a structure. You speak with the service providers. They take much of your time, so you have to be sure that on the operational side everything is set and working in perfect conditions, etc. So the time factor, I think, in the end, is one that is really a priority to focus on. And I think someone who wants to post some good figures needs to be focused 100% on running a product. So optimally, if possible, and is to have a team since day one who knows that are working well together, who know each other well, and who know the strategy well. And then you have that business development person who acts as a product specialist and goes out there and saves that much time for the CIO, the PM, not to do the intro calls and meetings and discussions with potential investors. At least this allows some kind of selection and filtering out those who won't be interested in the end for ABC reasons. So I think that's a massive time gainer to have someone doing that filtering in the first place.
All right. Very interesting. And since you already kind of spoken to the point that money doesn't grow on the trees necessarily, and posting your strategy up online and showing good result doesn't necessarily bring you a lot of investors. I know in the US the hedge funds are kind of constrained in terms of the type of marketing they can do, because they're supposed to be targeting only accredited investors, and typically their websites are password protected, and you need to qualify before you are able to even look at the potential investment possibility. How does it differ in Europe? Are the hedge funds able to do any sort of marketing to the potential clients? And what are the regulations? What are the outreach? What are the typical marketing outreach strategies that the fund managers are able to utilize?
Look, so first, as a little caveat emptor, I'm not a lawyer, so what I'm going to say is to obviously to be verified, and I will explain why. You will understand why, and also to be checked with lawyers when if a manager listens to me right now and decides to go on based on what I say, then it's not a good idea. Please don't.
You have to say disclaimer. It's okay.
Disclaimer is there. All I wanted to say. So, of course, in Europe you can market, yes, but now it's getting even more complicated. Since August the 2nd, we have a new directive under the AIFM that has been implemented. That was introduced already back in 2019, and now that it was the deadline. And European countries, the states have, not everyone has drawn up the legal papers and legal bills for this new directive. Germany has, for instance, but other countries are still lagging, and probably Europe is going to give, the Union is going to give another 6 months to get everyone aligned. So what can you do? What could you do before? For instance, maybe for some US managers who are listening, this is interesting. Prior to that, you could use the national private placement regime in some places like the UK, for instance, and then there are specific rules to Switzerland, and other countries had also some exceptions. This is, and there was also the famous reverse solicitation argument that some of them were using on a pre-launch basis, saying, I'm going into Europe, just talk about a strategy and it will be fine. And then I hope that these investors will be interested enough to come back to me. This is now getting to an end because the regulators are trying to clamp down on reverse solicitation by doing implementing a pre-marketing period. So now, if you come into Europe, any country in Europe, I'm not including the UK because it's no longer in Europe, you will have to adhere to certain rules and notify the local regulators that you are approaching investors, etc., etc. And then you will have a lockdown period of 18 months where reverse solicitation will not work. So the entire thing is getting more stricter, more regulated, more overseen. They will obviously regulators want to avoid not excesses, but abuses by some marketing teams that approach retail investors who have no idea. So this is the main target. This is to protect the retail investor, but it is just affecting everyone. So, and then there are other rules about communication, how you communicate your marketing, and that will take a step further. I mean, that you will have to be even more transparent. Everything will have to reconcile with, for instance, your fact sheet will have to reconcile with your presentation. If there are discrepancies, they will be picked on, etc., etc. So I don't think the freedom of just going out there and doing some social media stuff and etc. This is a bit over. And managers already, like in the US, here on their websites have a dedicated section with a password. So they are pre-qualifying everyone before allowing anyone near information that would lead to an investment. And I think that that's the important thing also with these new rules, is any information that could lead to an investment that is enough kind of information or advice or whatever you want to call it to make an assessment, a proper assessment for an investment will be seen as marketing. So there's a clamping down on that front. So it's getting harsh. And then for people like us, then I won't go into to make it too long into the differences between now with the UK being outside of Europe. It complicates things. There is no clear direction on that. But Germany has done one thing, and non-EU and EU AFMs are treated the same way. So they have decided, in order to avoid any imbalances in the text, in the legal text that are there right now, because non-EU AFMs are treated a bit differently in some instances. I don't have all the points, but you see where I'm getting at. To avoid these potential, so that a non-EU manager can have some loopholes, they are treating everyone the same. And I think the rest of Europe will do exactly the same. So you will have to adhere to the directive. It's
right. Yeah, we already heard. I mean, I'm in the FX side. We've dealt quite a bit with with the legal advisors on the issue of reverse solicitation, because, for example, for the firm like Advanced Market that doesn't actually work with retail, we target only professional investors. There are certain countries in the European Union post Brexit that do not allow you to, not even allowing the reverse solicitation, right? You just must establish an office and, have the local staff and abide by the local regulations.
Yeah. So look, it's which leads to everything. So I think the light kind of PR exercises that some are doing you can probably only say, hey, hi, I'm a credit manager and I'm able to do this, and we have some good years. That's it, full stop, and you won't be able to.
For further information, you must qualify.
Exactly. So yeah, that's where we're going, unfortunately.
All right. Well, I guess I can see the point of the regulators trying to protect the retail, but on the other side, it kind of stops the business. So
it's getting a bit much at the end. We'll see in practice how it will be. But I think for a lot of people, and like for ourselves, for instance, it will force us to restructure a few things in order to be able to do what we're doing today. So it's another burden, another way to extract some money for the regulators.
Right. Interestingly enough, speaking about the capital raising, the capital introductions is one of the ways to get the capital in. And, I guess historically, a lot of hedge fund managers use their relationships at the prime brokers to be able to, get those introductions to the investors. But right now, that situation is not, trivial anymore, because basically to even get onboarded by the prime broker is kind of a challenge for those small to mid-size investment firms, just because of the credit crisis that the world has gone through. The capital requirements are much higher than there used to be, and so it's a struggle. Are there any other relationships that kind of start early stage fund managers can leverage to get the capital introductions apart from the prime brokers? I mean, if you're not able to get prime broker, obviously you can't get the capital intro from them.
Look, I think that is just on the prime brokers. I agree with you. I think it's been a while since it's been a while I'm hearing from early stage managers that the prime brokers are promising introductions. They make some introductions, but obviously not making the follow-up leads to very often nothing. So they're a bit disappointed by this promise that prime brokers make. But that's not sort of the point. What are the other avenues? The other avenues are there are other service providers around, dotted around. But for instance, in Europe, you have, if you are an early stage managers and a manager, and you are using service providers like platforms, mancos, and etc. They have some their own distribution force, and I cannot now say out of the 50 platforms that are out there, all of them have a distribution force and it is 100% efficient. Most of the time also I have heard managers complaining about also lack of support on that end. So it's agreed on a case-by-case basis, but a lot of service providers like lawyers and administrators get involved in the process, and we are receiving a lot of new inflows of ideas and seeing new managers via that way. It's just a lawyer says, look, I have this new client here, looks interesting, I thought about you, speak to him and see how it goes. So I think you have just to leverage on try to use the best-in-class service providers, and they will direct you. They will. This industry is we all talk to each other. So if you have a good offering, people will talk about it.
Right. Great. So I'm sure you've looked at, because you work and you have your own advisory firm, you've worked with many different early stage managers, and probably have taken a look at thousands of pitch books. What do you think are the top 3 mistakes that people make when they're preparing their pitches? When you look at that pitch book, I mean, there probably is somewhat a structure that you expect, and probably some people are, missing some critical parts.
Yeah, look, I'm maybe a bit different. I don't view myself as a pure PR marketer. I view myself more as a salesperson. So then depends from what angle you look at this, marketing or sales. From a marketing perspective, let's just go on arguments about the form. I think, as you say, now there are thousands of decks out there. They all look exactly the same. I think one mistake is not to have a perfectly organized, format-wise deck. You will stand out by looking bad, and I think it's just expected that your deck looks that has a nice design, and that there are no mistakes in terms of whatever figures and grammar and stuff like this. It's basic, but it's just first impression counts, and we are human beings. We like nice things that are looking good and looking professional, and that brings a bit of confidence. But for me, okay, I'm not going to base everything on a nice looking deck. It has to have some content, and I think the main challenge for for a manager, is that the potential investor, the prospect he's talking to, has seen, probably, if we talk about just say long short equity or even FX fund, he has seen thousands of these things, and managers very often do not realize that they have to highlight the real edge they have. Or if they think they have an edge, they have to highlight this, and that's the most important thing. I think that's they underestimate a bit the importance of differentiating themselves from the crowd. They just think, okay, I have this fund, it performed well, people will come. It's not happening like this. It requires a lot of work, and you have maybe another bit more kind of not deeper, but approach is also to think, if you can, at the audience you're talking to and what their typical asset allocation is. If you can make a point, an argument about this is how I, the manager, fit in your asset allocation, and this is what I will bring you in terms of correlations, in terms of risk profile, etc. that is an advantage. And that's where the BD guy, the sales guy, makes the pre-work on this, is in the understanding this, having that initial discussion, and then you can show a presentation that is adapted to a client. And I think that needs to be done. You need to be more not more bespoke, but more focused on who you're talking to, instead of being too general.
Right. I think it's with everywhere else right now is, clients' attention spans are short. They've seen it all before. You have to personalize, as you say, you have to make a case. You have to look at their business first. Don't just use the generic deck, right? To, go and pitch the investor that, seen it all thousands and thousands of times.
Look, if you can customize it a little bit for each target audience, I think they will feel more that someone is talking to them directly rather than just having a generic discussion.
Right. Which completely makes sense. I think, for all of us in sales, we do it with the clients right now. Clients are more demanding on the B2B side than ever, right? They want you to do the work. They want you to show that you prove that you've done the work, right?
Exactly.
Nothing falls easy.
No.
Great. I just had a question about the generally the hedge fund industry. I've seen that, I think a report maybe from HFM that, obviously 2019 wasn't a good year, but 2020 there's been quite significant inflows into hedge funds. The industry is currently probably topping 4 trillion in the AUM. What do you think are the major drivers behind this growth? Is it the pandemic? Is it the low interest rates? What are the major drivers behind the growth in 2020?
Look, if you look at the industry, I think it's definitely there is some demand. We have had 10 years of low interest rates. We're probably going to. It's probably the likelihood that it continues that way is quite high. So you have to go somewhere where you have higher returns. And I think there have been already for a few years, but I think some cracks in the wall. And people are slowly, but maybe surely, getting a bit worried about their equity-only exposure and being long equity markets forever. This is not going to last. It cannot last. So that's why hedge funds have seen a little bit of inflows last year, and mainly in the bigger funds. And because one, there is the idea of using someone that is actively managing your capital. One, and secondly is also limiting the downside. I think that's very important. But in the end, you still see most of the money going into places like private equity, and there's a lot of dry powder there. And the returns in the end, I think. Hedge fund returns are not yet to a point where you would say, oh, this is great. This is more liquid than private equity, and it has the same return. So still people are splitting a bit their capital, and most of it goes to private equity because just the expected return. And you don't see the volatility either. So it's a fantastic situation for them. But look, it's mainly, I think, a slow move back into an asset allocation that is slightly more defensive, but it obviously changes every 3 months depending on what the Fed and the other central banks are doing.
Right. Yeah. And then on topic on that, the diversification, I think I haven't had a podcast yet where we haven't spoken about crypto because, that's a hot topic. Yeah. So recently I've been reviewing this report by PricewaterhouseCoopers on the crypto hedge funds that indicated that, the AUM has been growing tremendously to about 3.8 billion in 2020, which is, a relatively small figure considering, the overall size of the hedge fund industry is AUMs. However, the growth has been phenomenal. Do you see the appetite from the investors that you're speaking to of crypto investment? Are the institutional side is the institutional side still, doesn't want to get exposed due to high volatile nature of it? What are your thoughts on, the overall growth of the crypto hedge funds investments in general?
Look, it's definitely. we had our first kind of exposure to this. I had personally my first exposure to this in 2012. Just dismissed it completely, and it was okay. Now, with hindsight, very stupid, but that's the way it is.
So did many people.
Yeah, well, that's the word anyway. So in 2017, we had our first client who tokenized his private equity fund. So that was an interesting first kind of dip into the space. And back then, obviously, no ways we could pull an institutional investor, so semi-institutional, so family offices and above, into this, because there were way too many concerns about security, about volatility, and still today volatility, but obviously no ways that someone could justify placing fiduciary money into the space. However, the environment, or let's say the sector, has grown, has matured a little bit. It's still very early in the process. And if you see big companies like Fidelity and more service providers providing the right solutions for a fund management sector that is growing, I think this is, first of all, I think this is there to stay. The performances are too interesting right now. The opportunities that volatility is providing are too interesting not to look at. That's why you see a lot of more and more managers, I'll call them traditional managers, looking into crypto and deciding to make the move and go in there, because they can apply their former strategies into crypto, and some of them work very well and have some handsome returns. So I think that will also be a competitor to maybe private equity because of the liquidity, as long as these returns stay, but you have the volatility. So this is obviously a problem. So we've seen at the beginning of this year, from last year into this year, big institutions like Ruffer putting some money at work into Bitcoin. So there is a bit of the approach was generally from a lot of investors was to go directly and to find a way and use a safe way to just be exposed to Bitcoin or Ether, and then the rest. We don't touch, not enough capacity, not enough liquidity. Now it's changing. Now that we have kind of a lot of volatility, we had in May. A big correction. We had now one at the beginning of September. Last night, with the Evergrande story hanging over our heads, there has been some volatility too. So I think investors will consider someone that manages actively their assets via funds or managed accounts. And managed accounts for the time being are the preferred route into the space, because the investor can cut straight away the access to the manager and just pull the plug whenever he wants. Funds, I think there are still some issues with service providers around the world. We don't have enough good service providers to have this industry grow to where it will be there. We'll get there. It just takes time. Just as an anecdote, I had someone who wanted to launch a fund of fund in crypto who decided to postpone, not to postpone, but to go directly rather than create a fund of fund, because he couldn't find 10 managers that were kind of giving him the operational solidity that he requires. So we're still at a point where it's a bit weak on that front, and there are some weaknesses that need to be sorted out. But I think it looks quite interesting from my perspective.
Right, and because you mentioned tokenization, I think that's another trend that I'm personally seeing. I've had a lot of inquiries about people who are looking to launch a fund, and they want to do it through the tokens. They want the investors to buy tokens in the fund and completely move it to the digital side. I wonder if it's going to revolutionize, in fact, the way that administration of the funds is currently conducted, right? Where you utilize all the service vendors. I mean, if you do that, and the tokenized fashion, like, do you really need all the service providers that currently might be utilizing?
That's probably why a lot of service providers and banking institutions are not too happy with crypto and want them to be regulated, because they're pushing a bit the problem further down the road instead of having that replace them. So we will see, but we'll find you have to have compromises. We will find a way, and we'll get there. But I think it's really something to look at. It's worth it.
Absolutely. Ronald, thank you so much. It's been a phenomenal episode. Thank you so much for sharing your views and your wisdom with the listeners. And if you want to share anything, how they can find you, I mean, I will post in the notes to the episode, we'll post your LinkedIn profile. But if you have a Twitter handle or any other way that people can communicate with you, please feel free to share. I
will, but the LinkedIn profile is the best way to do it.
Excellent. Thank you so much, Ronald. It's been a pleasure.
Thank you. Thank you.
Bye.
Any views or opinions presented on this podcast are solely those of the author and do not represent those of Advanced Markets. Trade in foreign exchange or other financial instruments on margin carries a high level of risk and may not be suitable for all investors. The high degree of leverage can work against you as well as for you. Before deciding to invest, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or more of your initial investment, and therefore you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with trading and seek advice from your broker or an independent financial advisor if you have any doubts. Anyone opening a live trading account needs to adhere to the laws of their local country, as such laws may differ from country to country. Advanced Markets expressly disclaims any liability for any lost principal or profits without limitation, which may arise directly or indirectly from the use of reliance on information provided through this podcast.